All right, let's just jump right in. Today, we're going to break down a really simple, repeatable framework. And this isn't just some theory, okay? This is used by a verified 8-figure trader. We're going to distill what feels like years of complex ideas into one actionable strategy. And that quote really says it all, doesn't it? The whole point here isn't to add more confusion. It's to cut right through all the noise, to give you a clear path. We're simplifying what so many traders spend months, sometimes even years, just trying to piece together. You know, the world of smart money concepts can feel pretty overwhelming. There's so much jargon, so many intricate rules, but here's the thing. A profitable strategy doesn't have to be complicated. It just needs to be clear and it needs to be consistent. So before we can actually build the blueprint, we need to get our hands dirty with the 5 essential building blocks. Think of these as the fundamental principles that make this entire thing work. Let's get into them. First up is the trend. Super basic, I know, but it's absolutely crucial. Is the market going up, down, or just chopping sideways? This entire framework is designed to find those really high probability setups inside a clear uptrend or downtrend. We're trying to ride the wave, not fight against it. Next, market structure. This is basically how we read the health of the trend. And the key signal, the thing we're looking for, is the market structure break, or MSB. So in an uptrend, when price breaks above a previous peak, that's a powerful, powerful sign the trend is probably going to continue. In a downtrend, of course, it's the opposite. This confirmation is exactly what we're hunting for. Okay, so the trend's confirmed. Now, where do we actually look to get in? Well, that brings us to our point of interest, or POI. And the main one for this strategy is something called an order block. It's that last little down candle right before the big explosive move that broke the market structure. That's our spot. That's our high probability zone. Now let's talk about liquidity. Just think of it as the market's fuel. Price is basically engineered to move toward areas where there are tons of orders waiting. We call these liquidity pools. Now, external liquidity sits above recent highs and below recent lows, where everyone's stop losses are. Price will often go grab that external liquidity first, and then it pulls back to an area of internal liquidity, like our order block, to refuel for the next leg up. And finally, premium versus discount. This is such a simple but powerful rule. Buy cheap, sell expensive. That's it. If you just split any trading range right in half, you get a clear line. Anything in the bottom half is considered a discount, a great place to think about buying. And anything in the top half, that's premium, a great place to think about selling. All right, now that we have those 5 building blocks in place, let's actually put them together and construct the blueprint. This is where it all clicks, and we can find our directional bias and start pinpointing those high probability zones for our trades. Here it is, the blueprint in 4 clear steps. We do this on a high time frame, like the daily chart. Step 1, we wait for that market structure break. Step 2, we define our range, from the low that started it all to the new high. Step 3, find our order block inside that range. And finally, step 4, we just patiently wait for price to pull back to our POI, making sure it's in that discount zone we talked about. A really great way to picture this is to think of the price as a ping pong ball. It shoots up, takes out the external liquidity at a high, and then it bounces back down to an area of internal liquidity, that's our order block, before it launches right back up again. It's this simple back and forth that really drives the whole strategy. So we found our high probability zone on the big picture chart. Awesome, but how do we actually get into the trade with any kind of precision? Let's move from the blueprint to the actual execution model. This is the million-dollar question, isn't it? I mean, we know the area we want to trade from, but nailing down that exact entry is what turns a good setup into a great one. It's what gives us a real edge. And to do that, we use the sniper scope. What that means is we switch from our high time frame chart, our daily or weekly, and we zoom way down to a lower time frame, like the 1 hour. We're zooming right in on our point of interest to find that perfect moment to pull the trigger. This right here is the breaker entry model. It's a 4-step process for a super precise entry. So once price dips into our high time frame POI, we start watching. Step 1, a small low forms. Step 2, that low gets taken out. That's a liquidity grab. Step 3, the market structure breaks to the upside, showing us that buyers are stepping in with force. And finally, step 4, we look to enter as price comes back to retest the very level it just broke from. So why? Why go through all this trouble? It all comes down to risk to reward. A standard, kind of lazy entry might get you a 1-to-1 ratio, but this precision model, we're aiming for 2-to-1 or even better. And this is completely non-negotiable for the strategy. It is the absolute key to long-term profitability. Now, this all sounds fantastic, but let's take a breath and get a quick reality check. A simple framework is incredibly powerful, but that doesn't mean it's easy. Success is going to take a lot more than just knowing the steps. So let's be real about it. The pros, they're huge. It's simple, it's mechanical, and it's universal. But the cons are just as real. This takes work. It takes screen time. It's not going to work in every single market condition, and you will have losing trades. A little bit of discretion and experience, yeah, that's still part of the game. So, how do you actually succeed with this? Well, practice is number one. You have to put in the chart time. You can also add confluences, like making sure multiple time frames are all telling you the same story. That helps you identify the A-plus setups where you can use dynamic sizing and risk a little more. And finally, you've just got to be adaptable to whatever market you're trading. And this brings us back to the math. And this is so important. With a strict 2-to-1 risk-to-reward ratio, your break-even point is just a 33% win rate. Let that sink in. You do not need to be right all the time. You just need your winners to be bigger than your losers. And this quote just drives that point home. All of a sudden, being profitable doesn't seem like some impossible dream. If you can just manage to be right 4 out of 10 times with this model, you are on the path to becoming a consistently profitable trader. So there you have it, the entire blueprint, from the big picture idea all the way down to the precision entry. You have the framework. The only question left is, are you ready to do the work?